Good afternoon. I think that we may start, if you agree with your agreement. Welcome to everybody to this last symposium, I think the number 9, the last one, about the role of business model linked with the problem of consistency of accounting standard, the use, the implementation of them. We are very happy for the level of the panelists, excluding evidently myself. I have only to chair the meeting as chairman of Organismo Italiano di Contabilità, the Italian National Standard Center, who has organized this symposium in union with EFRAG. I think that I have not to explain you what is EFRAG. In any case, many thanks to the European Association of Accountants for this invitation. We have with us Sue Lloyd. It is a great honor to have you with us, Sue. You are a very important person in the field of accounting standards. You chair the interpretation committee. Good luck. You are vice chair of International Accounting Standard Board. Again, good luck. We work together in EFRAG in links with International Accounting Standard Board. We are happy also to have here with us Anna Martin Pina. I don't know if I have pronounced it correctly.
Quite good.
Thank you for being here. You are Vice President of the Spanish National Security Market Commission. You are in the area of regulators. So that we have the standard setters, international standard setter, the regulator. Anna is also chairing the ESMA Corporate Reporting Standard Committee. We have with us a prepare, Luca Cencioni. He's with me, we are together in the board of EFRAG, and mainly he is member of also of the board of OIC, and he is also financial officer of an important industrial Italian preparer, the ENI group. We are very happy for having with us the Academy, Peter Pope, professor of London School of Economics, UK. London School of Economics was the goal of my generation to reach this so important school and attending their lessons. From the part of users, we have with us Jacques de Greling, Vice Chair of EFAS, and he represents the users. I think that if you agree, we may start. The program is to have a presentation from Sue Lloyd at the beginning, and then to discuss following question by question. We have in total 90 minutes, 70 minutes for the discussion, and then we will ask Andrew Watchman, who is still in front of us for the conclusions. If you agree, we start. So, if you may.
Angelo, thank you for your kind words. And firstly, let me start by thanking the EAA, EFRAG and OIC for the opportunity today to present on a topic that's very dear to my heart, both as the Vice Chair of the IASB and as the Chair of the Interpretations Committee, Consistency in Financial Reporting. So if we look at why the IASB was established, it was established to develop a single set of high quality, understandable, enforceable and globally accepted accounting standards. And if you look at our stated mission statement, which you can find on our website, it includes bringing transparency to global markets by enhancing international comparability to enable investors to make informed economic decisions. And in order to meet those objectives, not only do we need to write a single set of high-quality standards that get used internationally, we need those standards to be applied in a consistent manner. So I think it's pretty clear that consistent application of IFRS standards is pretty fundamental to our whole reason for being. And if we talk about consistency in financial reporting, I think there's two main aspects. One is the consistency in a single entity's accounting over time, and the other is the consistency in accounting between two different reporting entities. They're both important to users of financial statements in particular, but in the interest of time today, I'm going to focus on consistency between entities in my opening remarks. And to provide some context to what I'm going to talk about, I'm going to use as my background two different entities in two different parts of the world that we're going to assume are undertaking like transactions. And we're going to assume that both of them are applying IFRS standards and look at what could cause them to have differences in their accounting despite the fact that they started off applying the same set of accounting requirements. And I think the first aspect of consistency in reporting is that the two entities need to have a common understanding of what it is that we're requiring them to do when they pick up our standards and apply them. So we need them to be reading the words in a consistent way. And in order to achieve this, at the IASB, we need to write words that are clear and that are understandable. And also, to achieve consistent application of the requirements, we need to provide enough explanation to enable the two entities to reach a common understanding of what it is that we're being required to do. Now, at the IASB, we're very proud at the level of global adoption of our standards around the world, but ensuring that entities have a common understanding of what we're asking them to do when they apply our standards is made more complicated for us by the range of countries around the world that apply our standards, the different accounting backgrounds that people are coming to us from, the differences in their level of expertise in applying accounting and IFRS standards, and also the different levels of enforcement and regulation around the world. And last, by no means least for us at the IASB, we write our requirements in English, but then our requirements get translated into many other languages around the world. So although we put a lot of care into the translation process, there's always a risk of nuances being lost in translation. But going back to our two entities, let's assume that we have overcome the first hurdle, and so we've got the two entities to reach a common understanding of what it is that we're requiring them to do. What else can then cause inconsistencies in their reporting, even though they're both applying IFRS standards? So one cause of inconsistency is the options that we allow in the standards. And I'm meant to be referring to IAS 40 for those of you with an eagle eye. And we're going to assume that the two entities in my diagram both own investment properties. One could choose to measure its investment properties at cost, and the other can choose to measure its investment properties at fair value. Now, we know that options reduce comparability for investors, so we try not to allow too many of them, and we only allow options when we believe that there's good reasons for introducing them. But explicit options exist, and they're certainly a potential source of inconsistency. So at the ISB, we need to be careful to use them sparingly and wisely. Now, another reason why my two entities might end up with differences in their reporting for like transactions is where there's significant measurement uncertainty, or because of the application of judgment. So let's look at those two aspects for a moment. And let's go back to our two entities, and let's make a big assumption. Let's assume that our two entities both own an investment in unquoted equity in the same company. They measure their investment at fair value, and it's a level 3 measurement because it's an unquoted investment. So that means they've got to rely significantly on unquoted inputs when they come up with their measurement of fair value for their investment. This means that the amounts at which the equity investment in the same entity is reported in the two companies' financial statements is very likely to be different. And this is the case even though both companies understand what they're required to do, even though they both understand what fair value measurement means under IFRS standards and apply it well. So measurement uncertainty can give rise to differences in reporting outcomes. Now, the next example I'm going to use is one I often use when I try to explain to people, often people with an American accent, what I see as the difference between a so-called principles-based standard and a rules-based one. And this is where we get good examples, I think, of the effects of the exercise of judgment. So let's go back to our two entities. They've got another transaction, and they both hold 49% of the voting shares in two different companies. Now, those of you who have read IFRS 10 will know that IFRS standards generally require that all controlled entities are consolidated. And we're clear that there's no bright line for consolidation set at more than 50% of the ordinary shares in a voting company. So entities can control a company even though they hold less than a majority of ordinary shares. So the case of my two entities with their 49% investment in companies, ordinary shares, is a good example of a situation where they need to apply significant judgment to decide whether or not, in fact, they do control these entities, and thus whether they're required to consolidate them. And it's conceivable that even when they apply judgment well, and their fact patterns are similar, they can draw different conclusions about whether or not they actually have control over these entities. Now, ultimately, each company has consistently applied the requirements in the sense that they've consolidated all of the entities that they have assessed that they control, but there could be differences in outcome. So I think that's another example. Now, in all of these cases, different outcomes caused by options that we've allowed for, the effects of measurement uncertainty and judgment, these can arise even when entities understand well what we're requiring them to do and apply the standards well. But from a user's perspective, even though they're done legitimately, if you like, they still give rise to differences in the reporting, and it affects comparability for entities trying to use the financial statements. So to try to assist the readers of the financial statements, we require disclosures to explain accounting policy choices that have been made, to explain the assumptions that underlie measurement in these level 3 type situations, and to explain the key judgments that have been made on material decisions like whether or not you control that 49% owned entity. It doesn't make a substitute for recognition and measurement, but we try to assist. Now that brings me to the final cause for potential differences in financial reporting and the topic that's included in the title of the session, the effect of business model on financial reporting. So if you've looked at our new conceptual framework, you will have seen that it highlights in the new measurement chapter that in circumstances where more than one measurement approach could provide relevant information, differences in business model may make different measurement bases appropriate for the same item. So what does that mean in practice? And let's go back to my two busy entities. And let's assume, first of all, that they both own derivatives. Under IFRS standards, derivatives are always measured at fair value. We only think there's one relevant measurement basis because these financial instruments have got such uncertain cash flows and are highly leveraged. So both entities would apply the same measurement basis, fair value, for their derivative assets. But let's say that both entities also hold government bonds. Because both amortised cost and fair value can provide relevant information about simple bonds in particular circumstances, the accounting for the bond is going to depend on the business model within which each entity holds the bond. And in this context, when we talk about business model, we don't simply mean management intention or free choice. We think it's a matter of fact based on evidence such as business plans, how management's compensated, evidence that you can look at to reach your conclusion, but the business model will drive, in part, the accounting. So if entity A holds its government bonds in its trading book, we'd require them to measure their government bonds at fair value through profit or loss. Whereas entity B, who holds the same government bonds, if they hold those government bonds to collect their contractual cash flows over their life, they have to measure those government bonds at amortised cost. So same bond, different accounting, because it's the same bond in a different business model. So the effect of holding the bond on these two entities is different. The entities will use the bonds in different ways. Entity A is going to try to profit from holding the bonds by selling it at the right time. Entity B is going to try to profit from holding the bonds over its life. And all entities who hold simple bonds to collect their cash flows over time will measure them the same way, at amortised cost, and all entities that hold simple bonds to trade them will measure them the same way, at fair value. But not all simple bonds will be accounted for in the same way. So the accounting is not uniform, but personally, I think that's an example of consistent reporting for consistent things. Now moving on to who's responsible for getting a consistent outcome in the reporting. And I think at the IASB we've got a really important role to play in consistent reporting, and I think consistency certainly begins at home. So it starts with clear standards that can be translated and that are understandable. If we mean the same thing, we should use the same words, and we should provide sufficient guidance to facilitate a common understanding of what is being required. And I think it's also fair to say that the IASB's role supporting consistent application has actually increased over time. If you look at the new standards that we issue in the last couple of years, they tend to provide far more examples that illustrate the application of the requirements. And also the IASB is using different techniques to explain the requirements. So for example, for the newer standards, we provide webcasts that don't go beyond what the standards require, but we're trying to explain the standards in a different way, using different techniques to make them more understandable and accessible. Entities still need to read the official words, ultimately, when they use the standards, but if you've listened to the webcast, you've got some context, which I hope aids understanding. The other thing we've done is establish transition resource groups that discuss application questions in a public forum during the implementation period for our new standards. And also we're using the Interpretations Committee much more actively than we did in the past. And what do I mean by that? We're trying to get the committee to answer questions more quickly so that it can address diversity more quickly. And even when the committee decides that standard setting in the form of an amendment or an interpretation is not required, we're trying to provide support for consistent application using the committee's agenda decisions. Now, we used to call the agenda decisions rejection notices, and you'll see a change in our description because the term rejection notices, I think, really undersells what the agenda decisions can achieve. So we're using the agenda decisions to do things like explain what requirements you would need to apply, what judgments you would need to make, using the standards to answer the particular question that was submitted to the committee. And through all of these additional actions that we're undertaking, we hope to address that first source of inconsistency I talked about, ensuring that entities have a common understanding of what they're being required to do. But we're not the only ones who have got a role to play. We can only do so much. And importantly for us, we've got no ability to enforce our standards. In order to achieve consistent application, we need the help of others and we need to work with others. And all of the participants in the system really have a role to play to achieve consistent application. It starts with the preparers. We need them to apply the standards well, and we need them to tell us when things aren't clear, so we know when we can step up and help them out. We need auditors and regulators to help by enforcing consistent application of the requirements, including encouraging preparers to use our agenda decisions from the Interpretations Committee, which aren't mandatory, but which help support consistent application. Investors have got a role to play, providing market discipline, asking questions and pushing for good disclosure and application. And there's also an important role for those of you in the room today who are teaching the accountants of tomorrow. Consistent application starts with a good understanding of the conceptual framework, a good understanding of our requirements, and training in the application of judgment. And also I think there's a role for academics in helping us to understand the reasons for why differences arise when our standards are applied around the world, because that information can help us do a better job going forward. And I'm going to end there, hopefully having set the scene for what I expect will be an interesting panel discussion on this very important topic of consistent reporting. Thank you for listening.
Thank you very much, Joe, for this rapid but very interesting introduction. This is the approach and the view of an international standard setter. Evidently, consistency is not already reached. The problem is if we may reach consistency or not in future, and why we have this kind of problems. You have concluded your exposure making reference to the role of others. Now here we have the others around us. We have regulators, as we have seen. We have investors, preparers, and academics. We may start. The first question is if consistency is not yet reached, surely, for many reasons, is consistency so important, or it is something that we may accept, or in any case is something with which we may survive, we may live? It is so important to be consistent or not? This is the first question for starting a discussion, and I think that this question has to be addressed first to a regulator. Anna May, which is your opinion? Is it so important to be consistent or not?
Thank you, Angelo. And first, I would like to thank EAA, EFRAG, and OIC for organizing this symposium and for their kind invitation. I will try to bring the perspective of securities regulator to this panel discussion, and the answer is yes. Consistency, we believe it's very important. Consistency over the time and consistency between entities is an essential component of financial reporting that contribute investors to make more informed decisions. ESMA, which is the European Securities Market Authority, issued in 2014 its guidelines on enforcement of financial information, and the guidelines remark that in order for investors to be able to compare financial information among different entities, this information has to be based on a consistent application of the relevant financial reporting framework. In this sense, in the guidelines say that if facts and circumstances are similar, the recognition, presentation, disclosure, and measurement criteria have to be similar to the extent allowed by the financial reporting framework. Also, in the conceptual framework issued by the ISB in 2018, there's a statement that says that comparability is the goal and consistency is the way to achieve it. We as enforcers totally agree with this goal and with this statement. So we believe that in order to achieve consistency, explicit and implicit alternatives in accounting policies in IFRS should be eliminated or at least reduced, and this would imply having a less flexible framework with robust principles that are combined and supported by clear guidelines. There's also another issue important in relation to consistency, which is linked not only to financial reporting, but also non-financial reporting. In the past years, we have seen how disclosures related to environmental issues, social aspects, and governance of entities has grown. In fact, in 2014, a directive on non-financial information was approved. Now it has been transposed in most member states, and we, as enforcers, have now to review how entities report this non-financial information in their statements. And the difficulty for us is that this non-financial information might be reported according to very different frameworks. So it's very difficult to find consistent information and to do a consistent enforcement due to this great variety of frameworks. So we encourage Europe, and we believe the ISB could have an important role to draw and to issue a unique framework regarding non-financial information.
Thank you very much, Anna. This is an important message. Evidently, consistency is important. Financial reporting is a product that has to circulate, and if we don't know exactly the rules through which this information is prepared, evidently the user may have a problem in receiving the message from this financial reporting. For this reason, I think, Jacques, which is the approach of users to consistency? Do you accept different message, or it is so important for you to have the same language, the same message?
I think it's absolutely key to have a common language. Even though you might call it a kind of Esperanto, you have to speak the same language. We would have difficulties in understanding the information provided to us if it was in, well, today perhaps in Esperanto. Today it's Globish, a new kind of English, low cost. But that's sufficient, I think, and it's a good common point. First, remember, it's an old problem, and this is not specific to IFRS. I mean, let's remember what was the EU framework under the 4th and 7th directive. As an equity analyst, I remember covering the Spanish telecom group Telefónica, and once they published their annual figures, I discovered that I had made a huge mistake on estimating the financial cost of the group. Finally, I discovered that Telefónica, in fact, included at this time a goodwill amortization in the financial section. I mean, the EU framework, the 7th directive, did not say what was the nature of goodwill amortization, but let's say putting it in the financial section was a strange option, to be polite. So it's not something really specific to IFRS. It existed in every framework. Perhaps also I should add that with real experience as a telecoms analyst, if you took a sample of 10 of the largest group in Europe on the operating section of the income statement, you would see all these groups have a very similar business. I mean, it's a GSM and it's internet access. I mean, very basic, no difference from one country to another. And when you look at this sample of the operating section of all this group, you will see that 90% using a per nature presentation, so rather common point, 10% using a per nature presentation, and 10% using a per nature presentation. And 10% using a per nature presentation, so rather common point, 10% using a per nature presentation, and 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 10% us one exception, but big difference. Then the number of lines is extremely different. You have 5 items in one group and 13 in another. So the quality of the granularity is extremely different. And on average, you have one subtotal between operating profit on revenue, but in some group you have 3. And you discover some new subtotals, usually about 2 additional subtotals in the slides. So you see consistency can be a real problem. If I want to compare a business which is very similar in one country in Europe to another, I mean, it's pretty basic. So it exists also today in IFRS framework. I would add that a few words, an additional comment on the convergence process we had for several years with the Raspberry. I must say that I was very naive 20 years ago. I was expecting that with the convergence with US GAAP and IFRS, we would get the best of the 2 universes. Well, I must say that I was a little bit disappointed, and on that point, I think the ISB did not do a proper job from the user perspective. And I think one of the best examples is the copy-paste with IFRS 8, which is segment reporting, which for analysts is the most important information, because it's where you understand businesses. And that was not a good move. And also, convergence also was an improvement for preparers, as there was a removal from reconciliation in US GAAP for companies listed in the US. And for us, this was a delicious details, because you could find some details and understand that with 2 different cameras, US GAAP and IFRS, you could get very different images. And this was a good signal. So it was very helpful, in fact, for analysts to get, I would say, 2 sets of accounts. And this has disappeared. So convergence is not so positive. So it's really a long march to improve it. I think in the current work underway, there is some good signal coming from the IFRS, and we expect that to have less frustration or less surprises when doing our everyday job and making investment decisions.
Thank you, Jacques. This is a first framework. The consistency is a problem. Consistency is important. Regulators are certainly interested in having major consistency, the major consistency possible. Users too. Now, if we go to the business model, each business are different one from the other, and preparers are interested in giving specific information through the financial information. Users, the same, are interested in having specific information business by business. It is interesting to have the view of a preparer. Which is your problems in front of consistency? Are you obliged to give specific information in preparing a particular financial reporting in different areas for different business? In few words, business model is important for financial information or not?
Okay, thanks, Angelo. I think that you touched one of the main aspects that when we have this sort of discussion relating to the consistency and the comparability of information among entities, between entities, and of the same entities over time. For sure, I think that we have to combine the principle of consistency with all other principles that characterize our financial information, and especially the one that is should be the golden rule, that is that we have to present the economic substance of our transaction and reflect the substance of this in our figures. For sure, the same transaction as you presented could be seen in a very different way, but it's not because there is a lack in consistency, because we are consistently representing consistent thing in a consistent market, in a consistent business. I work for an oil and gas company. For sure, I look for the acquisition of a tank of oil for my feedstocks in the refinery and marketing, very different from a trader seated in New York just to trade, because its need is to obtain benefits in the short terms. So the same transaction, it is not an option, but really should be presented in a different way. In this sense, I think that there is a combination between consistency and the substance of forms and the economic substance as the main driver that we have to present. The second aspect that I think that is important to underline is that the set of IFRS is a set that is general, so it's not, does not have the culture to have an industrial approach, so like US GAAP, in which there are many accounting standards specific for every kind of industry. So I think that is an element that could create more discussion, more elements in order to have and assure an appropriate comparability of information. Comparability of information that at the same time it is absolutely a need for entities that try to figure out inside their industry segments which are the best way to present activities, especially where there are no specific guidelines expressed by the accounting standards. Just to come back to the oil and gas sectors, in IFRS it is quite thin. There is only one paper, so it is IFRS 6 relating to exploration activities. Entities as determined which are the best way to present according to a framework of IFRS, but they have development specific guidance to have a practice in order to appropriately represent transaction in the exploration phase, in the development phase, and the production phase. This is a common language that is not only necessary to present to the market and permit users to have a comparability, but is a common language inside the business. When I speak with my friends in Exxon and we speak about the way in which we represent a transaction, have the same platform of understanding how the figures moves, it helps a lot in understanding the way in which we represent our figures and how we can cooperate and works. Now, just to present one item that is on our table nowadays, we are working very hard on IFRS 16. One of the main discussion is how to look at this item, especially when you have a joint venture or joint operations that are very common in our industry. For sure, if we do not agree in the same interpretation, in the same way to present, we will lack to have the possibility to collect the appropriate information to have our recording. So it is important to create inside the industry a common view to look at the same transaction in the same way. That does not mean that all transactions should be represented equally all around the world, but that there is, as you said before, consistency inside the consistent items. That I think that is the main lesson that we have to have in mind.
Thank you, Luca. And the academic view, Peter, which is the academic view about this aspect? Is it possible to have a general standard for each fact or act, or it is necessary to have different standard for different business?
Well, firstly, I think there's no such thing as a unitary academic view. There's probably more views than there are people in the room. But if I could just make one general remark, first of all, because I think my reflection on this from the outside of the standard setters and the regulators looking in is that there is a danger that we get engaged in sort of metaphysical discussions about consistency or comparability or even relevance. And one problem I have is that there's very little reference to what is the decision model that we think of users actually adopting. So it's helpful, I think, to have that test in the back of one's mind. If we took Sue's example on accounting for the long-term bond holding, I think in the back of one rationale for having options within the standard for fair value or amortized cost would be that in some senses, in the first case, the balance sheet is more informative for valuation type economic decisions, whereas in the second case, perhaps the income statement is more useful. That's an example of different decision models being in people's minds, I think, when they discuss issues like accounting policy, choice options in standards, and then also when we then talk about whether we should then reflect the business model. As far as business model is concerned, well, I took a quick look at some of the literature, the academic literature on business models. It may not be surprising to people to find that, management researchers find it impossible to agree on a common definition of the business model, which does then worry me when it enters into rationales or into accounting standards, because at the end of the day, one needs to be able to provide assurance, or the auditor needs to provide assurance that the treatment is consistent with the business model. And I think business models are often fluid, they're changing. They may include similar or identical transactions but performed for different purposes, and I guess this would be defensible by an issuer, by a preparer, but it does point to the difficulty of using business model as a criterion. And then I suppose moving on from that, accounting is about individual transactions and events. So there could be multiple rationales for similar events. The management intent, therefore, could be defended in accounting standards, and I think although Sue sort of distanced herself from intent and focused on business models, I could see some arguments for intent being a criterion. On the other hand, there are certain types of assets where I think it's difficult to argue that intent really matters. I think financial assets is a good case in point. Even the equity owners in a business which does sit there and try to collect cash flows from long duration bonds, they still may want to know the value of the claim as it exists today at the reporting date. So is it sufficient for management to argue that they're just sitting there collecting the cash and therefore they amortize the original cost? Or is there additional relevant information provided in the case of financial assets and other financial claims which would be useful to investors? I think we go back to relevance at the end of the day. I think in valuing those future cash flows that would be reflected in the interest gathered, in the interest received, there is still a lot of work to do in a valuation setting for a user. And the discount rate, the duration, and indeed the credit risks associated with these instruments are important, and a useful summary statistic for many of those dimensions relevant to the users is indeed the market valuation. So I think I'm out of time, but maybe we have other issues we could talk about later in discussion.
Thank you, Peter. Somebody wishes to add something to these aspects, or we may go on with...
I could add a comment.
You have a comment.
So I think that firstly, Luca made some interesting comments about industry-specific guidance on the role of business model, and I think where industry can come in is helpful in the sense of providing consistency between entities that are likely to be compared by investors, for example, is there can be types of transactions that are very common in a particular type of industry, or for example, a type of lease that might be very common in the oil and gas industry, where if everybody's looked at it collectively and discussed it collectively, that could be a helpful way in which industry sort of can be consistent with the application of the standards. And I think one thing Peter said was interesting as well in terms of business model, because I think personally, I think in terms of consistency in business model wouldn't really work to provide a good outcome from a consistency perspective if we talk about business model in very generic terms, like what you think your business model is and therefore what you think is the useful information. But I think if you take that basic idea of what does your business model mean for what sorts of cash flows that you're going to generate and what's the relevant information, and then that's developed at a standards level, that's when you can use those sorts of notions and develop them in a way that you've got a chance of having them applied more consistently in application. And I think partly the elephant in the room with the business model is the extent to which people believe that business model in itself should determine recognition and measurement. So you'll see in my presentation I was very careful to say that we would, at the ISB, would always think that derivatives should be measured at fair value because of their contractual cash flow characteristics. Some people would think business model should always be far more determinative, irrespective of what the asset or the liability was. And so there's some slight differences of opinion, I think, on that front.
Thank you. Thank you. There are somebody from the public interested in asking something additional explanation? No. We go on. Another aspect, the problem of detail, the principle-based approach and detailed rules. The history of accounting standard is that we started with a principle-based approach, then we added the rules, then we came back to principle-based approach because the rules were too detailed, sometimes rules are not so linked with principle, but if we go on and we come back to principle, we have different implementation, different use, different interpretation, so that we go back to rules. This is the history. Do you think that it is important to have detailed rules, or it is better to have a principle-based approach? This is a typical question for a standard setter. So please, may you...
I'm not going to answer that question directly. But what I will say is that we're certainly getting more of a call for consistency, I think, from the market generally, and also as an organisation, we're focused on trying to improve consistency of application. But I don't think in the first instance that means that we think we need to sort of write more requirements in the main part of the standard. Rather, we need to keep that as simple as we possibly can and as clear and understandable as possible. But I think what we are seeing is more of a call for the guidance and explanation that supports those requirements. So you'll see that we're getting more calls for examples, we get more push for explanations and the basis for conclusion that give good context around the requirements so people understand what's being required. And I think we've seen that particularly with some of our new standards. So if you look, for example, at the new revenue standard, which talks about the concept of transfer of control as the reason for determining when you recognise revenue. We've had to do quite a lot of work providing support so people understand that concept, because it's a new concept and people need to get used to a new idea. So I think when we're in the situation where we're changing ideas, we need to do quite a lot to help with understanding. But in the first instance, I think the parties that need to sort of step up in addition to us are the audit firms and the regulators, because we can write, clear standards, but if they're not applied well and they're not enforced, we're not going to get very far, so we need help. And the other interesting thing is that in the last strategic review that we did a few years ago, we got a pretty clear message that people didn't want us to be tinkering with the requirements all of the time. People still like this idea that it's a principles-based framework, and they don't want us making amendments to the standards all of the time, not least because it sets off a whole ripple of changes in legislation and things around the world, so it's quite disruptive to the system. But we're trying to balance that with providing enough guidance, so it's always very difficult to know where the balance is. And at the moment, I think what we're trying to do to try and help is not really make the requirements themselves more rules-based than they were before, but to try and use other sort of softer techniques, if you like the webcasts to give context, to explain the requirements, and also using the agenda decisions that we used to call rejection notices at the Interpretations Committee, which aren't mandatory, they're not new rules, but they certainly do provide another set of information to help people know what to do when they're applying the standards. And one of the benefits we have with the agenda decisions is that we can answer quite specific fact patterns, and we have done in the last few months on revenue recognition, where we think that for people to get to a common understanding, they actually need us to go to quite specific examples to explain the application of the requirements. But they're not mandatory. We hope regulators and audit firms encourage people to use them, but it's a different way of supporting the standards without moving to a whole rules-based framework. So that's sort of the approach we're taking at the moment.
Thank you very much. Which is the view of users about a principle-based approach or many detailed rules? You use financial information, you read financial information. Are you better helped in your conclusion and evaluation having a detailed rule, or it is important to have a principle-based approach, that it is also in favor of consistency?
I think I would say we need both. The principle base is a good starting point, but I think we need more details at some stage. That's life. Let's face it. We don't need to have everything, but we need more details everywhere in the food chain of information, from the standard setter. For instance, if you look at the current IS1 on the income statement, the level of disaggregation is extremely poor, to be honest. So there need to be more than the principles. If you want to have information that is really usable, understandable, and that provides value for investment decisions. So more details are necessary there. There are also so perhaps some more details for the preparers, because here the cultural background or the industry background might make them making different choices, or perhaps just feeling uncomfortable about making the choice. And sometimes they have different story to tell to the market. And in the end, perhaps there are too much leeway over there, so some details are also necessary there. I think also auditors could be a part of providing more details and having some big networks. They might come up with, let's say, common practices, and this might be a way to have more consistency with a starting point as a principle. Finally, I believe there is also a key stone in this process of the food chain for the financial information. It's the enforcement. It's a critical step. And ESMA has a key role to play for that at the European level. I must confess that I was delighted to read the latest 22-second report on European enforcers on the database. It was delicious. It was there were some collectors over there. For once, you can have some fun with accounting. So this kind of more details coming in is necessary for the game, and to have some reasonable food at the end in our, let's say, restaurant.
Thank you, Jacques. Anna, you wish to add something?
Just a little comment. Well, I come from a country where the tradition has been rules, and I also think for enforcers, rules are easier to implement, because if you see that an issuer or an entity does not comply with the rule, you have a straight way to go for. But I think rules sometimes are very strict, and they don't fit all kind of activities, and so I think the approach of principles together with sufficient guidance, which I think is the approach of the ISB, as you commented, and as also Jacques appointed, is the correct one, because it helps enforcers, and I think also preparers to have general principles, but then also detailed guidance which can orientate them through the enforcement and through the application of IFRSs.
Thank you, Anna. Also, Peter wishes to add something. The problem is important.
Well, maybe I could just follow up on the theme of enforcement. I really do believe that the detail in standards is really not what's necessary in order to produce more comparable or consistent treatments across the globe. Study I was involved in a few years ago now with a colleague, Hamia Meraslami and Georgia Tridis. We looked at impairment accounting and reporting and disclosure across a large number of countries. And there's considerable differences in practice, and I'm sure my colleagues around the table would sort of point to this as well as probably being one of the reasons why there is call for greater consistency. And, there's a large academic literature which has studied different accounting attributes, accounting conservatism, the timeliness of disclosures, the timeliness disclosure of bad news, and so on. And the instruments that are used are reasonably well validated, where we can see some clear footprints in the data that practices differ across jurisdictions. And the most obvious explanation for this is that enforcement is very uneven. So I wouldn't start looking at rewriting the standards or adding more details. The impairment standard is pretty straightforward, I think.
Jacques has to answer to you, Peter.
I think also the enforcer can act or improve the system if the rule is properly written also. And I would go back to one of my favorite subjects, which is IFRS 8, which is the segment reporting. If it's reporting the management decision, what is the power of the enforcer? It puts the auditors and the enforcer in a weak, uncomfortable position. So in a way, if the rule, if there is too much leeway in the standard itself, controlling it, it's almost impossible. So, I mean, it's not only a problem of enforcement. If the rule is not designed in a proper, workable way, it delivers poor results.
Luca.
If I may, from the preparer's perspective, I think that there is just another element of complexity that we have to add, that is that we have to run because our time to prepare our financial information is very short. And the main risk that I can see is that the financial statement risks to become a sort of compliance document, a very perfect compliance document, but absolutely late, useless when it's published. And on the contrary, we have to create a culture that supports the preparation of appropriate financial information that go to the real substance, having an appropriate choice of the details that we have to prepare, because I think that the markets, that the users are more interested sometimes in a very fresh information prepared well rather than to a compliance document. The risk that I see is that if there is so many difficulties in preparing the appropriate accounting standards, then the reaction will be to have some non-gap information. And this non-gap information has been under review also by ESMA that took it on the attention. So what we are saying relating to comparability of information is also one of the items that also ESMA underline it as a main element. So we are in an age of a very digital relevant transformation that will impact dramatically the way in which we'll prepare our financial information. We are in a Twitter area in which every time you have a very easy approach with the users of financial statements in any kind of way, even including social networks or whatever. And so there is the risk that the compliance document will be something in the shelves not very useful. We have to try a good balance between the pragmatic approach, the need to be very fast, and the level of details that are necessary.
Thank you, Luca. I think that the discussion is very interesting. As all interesting discussion, the conclusions are evidently not always easy. We have to go on with our round table. We have received from you at the beginning a list of factors that are against the consistency or provoke different implementation interpretations. Have you to add something to this, or are you satisfied? I ask this question to a preparer and then to the regulators.
But I think that...
I don't ask the user because they are always waiting for the product.
I think that we have touched the main item that is probably the level of judgment. That I think probably is the main issue. And for sure there is the structure of the standard that is based on this principal approach. Also, when we are preparing interpretation, there is an approach not to create a rule, but to look at the standards and to figure out if there is a problem in the standards, in the principle of the standards, rather than to create a specific rule. So I think that it is a value that have to be maintained, that has to be protected. At the same time, this for sure determine at some point in time some level of judgment, of business judgment, and the exercise of this level is the main topic. We were also when you speak about a standard that has the characteristic for a specific segment, now there is a discussion of IFRS 17 that is probably the first cases in which IFRS is going to look at an industry as a whole. So this is a very good experiment. At a certain point, there is a long and difficult discussion with not many easy solutions relating, for instance, to the level of aggregation. That is one of the main blocks that characterize. We were discussing this in Africa last time, a couple of days ago. So I think that the level of judgment is something that cannot be avoided. It is something that can be tackled in some way, and the best way is to prepare a standard that it sounds. But in order to be sound, it means that also in the preparation of the standards, there should be some analysis relating to, I will not say an impact effect, but in order to try to collect all the areas, all the items that can characterize that specific accounting, that specific business, and try to figure out inside which are the level of judgment that can be acceptable. In any case, the business go on, and therefore there is a level of judgment that in any case is exercised. And the culture, the understanding of the specific items and the good balance between how to look at this transaction considering your local law and the way in which the accounting requests to look. It's the key issues that can be fixed, but is, let me say, day-by-day activities for any preparers that have to prepare financial statements.
I think the main factors have been tackled. From our point of view, we've seen always three factors that may cause inconsistency. The first one is the lack of a defined accounting treatment for a transaction, but we believe that the ISB makes an effort to identify all the existing gaps and tries to solve them. For example, in its work plan, you included the accounting treatment of business combination under common control, and we really welcomed this inclusion in your work program. Also, the presence of different accounting policies and different choices of accounting policies may cause inconsistency. The explicit accounting policies have been most deleted in the majority from IFRSs, but there are still implicit choices. And of course, the third factor is the internal judgment, the management judgment when managers have to do estimates or to draw key assumptions. We believe that this is a big factor of inconsistency that, of course, might be solved, as we have said, with robust principles and standards, and also application guidance.
Thank you, Anna. Peter, have you to add something about this list of factors that are explained in
Well, yeah, just to add a little colour to what I was saying before, I mean, academic research has considered a large number of so-called institutional or legal economic factors which are thought to correlate or cluster together in a way which determines reporting outcomes through the enforcement channel. Or more broadly, the governance and enforcement, because corporate governance is also an important determinant of accounting outcomes or financial reporting outcomes. So there are papers my colleagues in the room would be familiar with, which have sought to understand the role of different economic institutional factors, which have been studied also in the economics literature in studying outcomes like economic development, as an example. At the end of the day, I think it really boils down to incentives of management, of preparers, the governance structures surrounding managerial decisions in firms, which in turn is a function of the diligence and the interest and the activism of the owners of shares in the business, or the monitoring activities of creditors to the business. Those incentives are clearly important and would be particularly important in the case of standards which include bright lines, which is often associated with more detail. Hence, I think good arguments for principles-based standards from that perspective. And then the role of the capital markets generally, and the extent to which capital markets rely on enforcement actions of regulators. Those are the factors which really, I think, the academic literature generally have found to be important in explaining international inconsistency, if you like, or differences in financial reporting outcomes. Again, all conditional on the way we measure outcomes, which people argue about, but we feel have some validity.
Thank you, Peter. If you agree, we may, owing to the time, we go on with the question number 6. That it is, we have seen that there are inconsistency, a lot of inconsistency. We have seen the factors. We have discussed about the business model. We have discussed about principle-based approach or detailed rules. Now, the question is, how do you think, and this is a question for everybody, how do you think that we may detect inconsistency and with a certain reference to the accounting options? Options are a part of standards. Is the option a way through which we may solve the problem of inconsistency? We start from Anna, and then we hear the Sue, and then the others.
Well, from our side, the way to detecting consistency is through the revision of financial information. This is what we do every year, and we compare financial information from one year to another, and it's our natural way of seeing if the information is not consistent. And also, I think for us, the analyst reports are very useful. It's another tool we use to detect inconsistency, and well, from our side, these are the main two ways of detecting inconsistencies.
Thank you. This is the view of regulators. The view of preparers, do you think that, are you interested in, first of all, are you interested in consistency, or for you consistency is not so important? What it is important is the way through which you give information, financial information.
For sure, we look at consistency as a must, not only to have a fair presentation of information to the markets, but also, let me say, internally, because the first items that have to take also in consideration that consistency is relevant also for the appropriate measurements of the performance of management. So it is important to have and to analyze the ability of this management to take decision in using the same metrics for the same characteristics and for the same items. So the approach of the preparers is for sure to prepare information appropriately, to have the correct representation and the appropriate representation, having in mind what we said before, that is to present the substance of our economic transaction. If I may add something, I think that there are 2 points. One is that the new set of standards, so what we are applying now, that is completely different from what we started. Nowadays, I think that has reduced a lot the items of gray area relating to the adoption of options and other elements. I think that those they are presented are nowadays, for instance, in IFRS 9, more relating to the goal to avoid the accounting mismatch in order to avoid another issues that could derive from a consistent applications. So in order I think that the IASB has made a very strong effort in order to have a more stable platform of standards, and that's for sure helps. The second element that I think that is important, and I quoted before, I think that also technology will help in order to reach some level of technologies, of consistency. Those that are experimenting, for instance, the preparation of financial statement according to XBRL languages are now facing some difficulties in order to collect all these items. And this is a very good exercise in order to define if you are misinterpreted or interpreted in a different way some part of the activities. This could create some issues. There is a big issue relating to the format, EIS1, and how to apply, because there are a big level of flexibility inside EIS1, not necessarily easy to reflect in softer languages, and that's an issue that should be taken as soon as possible. But I think that in general, technology, the possibility to have a free access to a lot of information will be a good help in order to detect inconsistency and try to figure out the best way to solve it.
Jacques, how do you think that inconsistency may be detected? Gives us some ideas.
Well, I think it's a tricky question. I think it's first by having a good understanding of the industry and the company. This is perhaps the key feature to be able to discover the inconsistency inside a company and between the companies. But remember also that the analysts are, let's say, prisoners of the information that are delivered to them, i.e., to speak about some of the recent debate about non-GAAP measures that Luca made an allusion. If for a company, I've got a name in my mind, they published a fiscal year 2017 figures about 2 months ago, and there was 30 pages of press release and 30 pages of slide deck, and there was no single financial statement and no gap measure, no single gap measure in all the documents. So this was all non-gap, pro forma, whatever, crap, to be honest. Let's be direct. The full set of financial statements was published 3 weeks later. I mean, in this case, I mean, we can do nothing. So, and by the way, I have to say that the ESMA work on non-GAAP measure helps a lot if it's properly applied, which in this case was not. But and I think the non-GAAP measures and guidelines provided by the ESMA is one of the way to better understand this content and to master them properly. Not to be fooled by a name without fully understanding what it means and what it includes or what it does not include. So I think it's a kind of a detective work, and I think there is also a final difference in discovering inconsistency. We don't have the power of the regulator, the enforcer. So if we are not pleased, if we don't understand, and perhaps we can dare to ask a rude question, what's inside that or whatever. And sometimes I must say the answer is something that means nothing. It's boilerplate. So that's a very different position from the enforcing point of view, I think.
Thank you. And you, Peter, you have something to add?
Well, detective work, I think, at the micro level is clearly critical to the functioning of corporate reporting and markets. But detective work at the macro level is also important. And there are patterns in the data, if you look at the data from 30,000 feet, which with some modeling can be revealing of abnormal behavior. So a lot of the tools that my colleagues in the room, the academic colleagues, will be using are seeking to identify abnormal behavior. It won't be at the level of the application of individual standards, but the sort of insights one can get in academic work, these are tools which are also being used by regulators in some parts of the world. And the tools are developing as we speak. There is information, for example, in the financial narrative that surrounds the numbers. It takes quite a lot of effort and technology to tease out information from the narrative, but those techniques are now being developed. The SEC has a model which was developed when Craig Lewis was the chief economist there, which looks at the information in abnormal accruals models, let's say, in combination with information in the financial narratives about whether there is abnormal mention of, let's say, receivables in the management discussion and analysis. So these macro tools are useful for both academics to pursue their interests in learning from the data, explaining the data, but also from the point of view of the regulators and indeed for auditors, I think, as well.
So, at the end of this discussion, have you some
Well, I can talk. I can talk about how we try to detect inconsistency, so that we can assess whether we need to do something. And I think there's a few different ways. One of the key ways is through the questions that we get. So on the new standards, there's a facility on our website that you can submit questions. And one of the reasons why we ask people to submit questions is if they think that it's unclear in the new requirements. Also, our transition resource groups are set up specifically to encourage people to send in questions if they think there's a risk of inconsistent reading of the words. So that's a early source for us of so questions on the new insurance standard, for example, are already coming in where people think there could be inconsistencies arising. And the questions that come into the interpretations committee are sort of by definition where there's inconsistent understandings, which is why the questions come in. But before, the other technique that we use, given that we sort of don't have the resources to read too many sets of financial statements directly ourselves, is trying to work in partnership with groups like the audit firms who have the benefit of looking across jurisdictions and across entities, so they're a good source of information for us about inconsistencies. And the regulators, particularly through when the regulators come together as a group through ESMA or through IOSCO, the international securities regulators, they're a good source of differences globally. And so we try and use that. But also one thing I should have actually put in my presentation, and Luca made a comment which made me think of it, is I think we need to be a little bit realistic as well with new standards. So for example, with IFRS 15, a brand new revenue standard, we hope ultimately that everybody around the world is going to apply that in a consistent way because it's converged with US GAAP. But it's a brand new standard and people are still getting used to what it requires. So I think it's realistic to expect a bit of a truing up period while the market gets used to what the words mean, how should they be read, how should it be applied. And don't think we should be too tough in terms of slapping wrists if people don't get it quite right in the first periods when they're applying the standards. And so I think introducing brand new standards in itself can be a source of differences in application because of that period of time it takes.
Thank you very much. Thank you to everybody. Andrew, now if you may give us some conclusions about, you have heard all the discussion. Andrew is the chair of the TAG of EFRAG, and it is important to have his view at the end of this very interesting discussion.
Thank you very much, Angelo, and to our panel. I've enjoyed this discussion immensely. I think it's been extremely insightful, and I've been asked to provide some conclusions. I don't think I'm going to provide any conclusions. I'm just going to call them closing remarks. That's all I'm going to offer here. We've been debating, I think, a very difficult conundrum. How can we reconcile the demands for companies in their financial reporting to be able to communicate in a way that resonates with their business model or management's understanding of its business model, to tell their story is how it's sometimes phrased, with the demands for consistency, which the whole panel has agreed is extremely important and is a fundamental enabler of comparability. Now, as a brief aside on the subject of business models, EFRAG has been very engaged in researching the role of business models in financial reporting for a number of years, and indeed we still are. We're currently investigating, in particular, the role of financial reporting standards in reporting the performance of long-term investing business models. So in that, at least, we have been consistent. Now, I think the ISB's new conceptual framework in systematically recognizing the role of what is referred to as business activities in deciding how assets and liabilities should be measured seems to us like a major and important step forward, so we are thankful for that. But perhaps this afternoon the issues around consistency have dominated the discussion more. So to try and summarize what I think we've heard, I'll start logically with the standard setter, with Sue. So Sue has pointed out, and others have affirmed, I think, that what I'll refer to as interpretive inconsistency is important, but it's clearly not the only source of potential inconsistency in terms of why the same transactions and events might actually be reported in different ways in the financial statements. Some of the other potential drivers or dimensions of inconsistency include the need for judgment, the existence of measurement uncertainty, and those are perhaps ineluctable aspects of the system of financial reporting that we have chosen, but there are also explicit and implicit accounting policy options in the standards, but then a whole range of more subtle factors to do with local gap and cultural preferences, contextual factors, differences in regulation and incentives that other panelists have spoken about. Luca, as a preparer of financial statements, whilst acknowledging the role of consistency, I think has cautioned that consistency should be not pursued overzealously at the expense of standing in the way of finding a common language within a business and between businesses in the same sector, and particularly not standing in the way of reporting economic substance. Luca commented that perhaps technology is the answer, and I hope he's right. It's certainly leading to lots of questions, but technology clearly has a big part to play in this debate going forward. Moving on to Jacques de Grelling as a user of financial statements. Well, Jacques has also affirmed the importance of a single financial reporting language. I think reflecting on Sue's acknowledgement that perhaps consistency starts with writing the standards in a clear and understandable way, Jacques has perhaps suggested that one or two standards in his view, IAS 1 and IFRS 8 on segment reporting, maybe don't quite meet that test, but one of those projects has recently been reviewed and the other one is currently on the ISB's active agenda, I would observe. As a regulator, I was glad to hear from Ana Martinez-Pina that despite the fact that perhaps rules can make life easier for regulators, she supports principles plus an appropriate amount of guidance. What the appropriate amount of guidance is, of course, is something which is a continuing striving to find the right balance. And Peter Pope, bringing an academic perspective, has perhaps also cautioned that business models are kind of hard to define. There is no consent, there is no common language for the terminology of business model, but we could perhaps do a lot more to understand the decision model applied by investors. So as so often we are dealing with trade-offs, and I've noted a number of trade-offs here. So the panel have referred to detail versus speed, to a sort of compliance mindset versus a communication mindset. Now that we have the business activity concept in the conceptual framework, but also characteristics of an asset or liability as determinants of a measurement basis, how are those traded off? And views will differ on that. But as practitioners, of course, we have to practice. Actors in the financial reporting chain have to act, and it strikes me that there is a great deal that we don't really know. I'm not sure we really do actually have a consistent understanding even of the term consistency. If we did, I'm fairly confident I don't think we have a particularly effective way of actually proactively measuring just how consistent or inconsistent financial reporting actually is. This is far from easy. And of those multiple dimensions of consistency and multiple causes and effects, well, do we understand their relative importance and understand ultimately how those different causal factors affect the utility of the financial statements, which is what matters at the end of the day. So here's where I think the academic world has been, but can continue to play a crucially important role. I would love to continue the quest for some better answers, or ongoing quest for better answers to those questions. The phrase some further detective work came up. Great. And I think the academic world, in helping us to perhaps not answer, but get better insights into those questions, can actually inform the whole complex financial reporting ecosystem of which we're part and help that system move towards the optimum balance, wherever that might be. So thank you very much once again to our excellent panel, skillfully moderated by Angelo, and thank you to the EAA for hosting our symposium, to the OIC for co-hosting it, and thank you all for attending. If you're attending the gala dinner, please enjoy it, and safe journey home.
Thank you. Thank you to everybody, and to the next time.